Most beginners try and pick too many things. It's either random stocks, too many ETFs, chasing the hype, switch strategies every couple of months, and then never actually build any wealth. I could talk about my own portfolio, mention, well, I've done that once recently. So today's video, I'm breaking down the most 3 obvious funds and what they could do. A simple setup you can do in any account, whether it's a general investing account, whether it's a stocks and shares ISA, or even your SIP. And you can hold these technically for decades with the right risk management. But I'm also going to run through a little simulation in real time so you can see it in real detail with a copy portfolio to showcase what £300 per month will grow into. Now, the first one is on the screen. It's a FTSE All World Distribution Fund. Simple as that. The fund that basically owns everything. Over 3,649 stocks, including US, Europe, UK, wherever, right? And that's the thing. The idea around this fund, it's simple diversification. Historically, it does 7 to 10% returns every single year. And it is the obvious beginner fund, realistically. And that's the thing. The weight of your portfolio as a beginner should be the highest in this. About 60% is what I'm going for. So as I say, true diversification. You cannot go wrong with having the entire market realistically. Obviously, some of the returns are better than others, like any stock market kind of situation. But because it's following the entire market, it makes it a lot easier. So you're not kind of stuck in that one washout if one big sector goes bang. Obviously, yes, there's going to be a heavy weight with technology within this because of the Magnificent Seven. However, that's been said, there's still a lot more stocks in here that will probably average it out pretty nicely. It will still have elements of volatility, but as I say, so does every fund. But even if you're looking over the last 5 years, we've had some good times and some bad times, but overall, it is a thing that you just keep buying into, and it should do all right. If you want to be picky though, and I know people will be, there is a lot of North America in here, obviously. There's still a decent chunk of emerging markets in Europe, but yeah, there will be some withholding tax, a little bit on some of them US dividends, but nothing too crazy. You don't get much dividends in this anyways. And as I say, if you want to be really picky, technology is about 32%, give or take, but could be a lot worse. And the next one is a dividend one. Kind of makes sense in a way. Now, this is the UK high dividend yield one. Now, some people will disagree, some people will agree, but it's always good to have a bit of income as well in your long-term portfolio. You can always mix up your ratios with this. As you get older, you start increasing. And this one's an interesting because for me, it's utilities, it's banks, it's consumer staples, but more importantly, it is quite regular in terms of cash flow. It's got lower volatility. It's only 52 stocks in here. It's smooth, it's good, it's great for reinvesting and compounding. As I say, the weight of this will be 30%, not 60%, 30%, and it will gradually just, snowball over time. Now, I know people will kind of moan a little bit about certain things around it. Certainly, obviously, the fees of it, it's a little bit higher, but obviously it is a distribution of a fund that will be managed quite heavily with the fact that it is the FTSE UK dividend stocks. Now, yes, it is the UK based. That is because you will get all of your monies in a stocks and shares. I said there's no withholding tax, which makes it very, very, very important. And yes, financials, consumer staples, utilities, some pretty big hitters here. But at the end of the day, the volatility is actually relatively low on here. Even though the performance has been pretty good, realistically, there's some good months, some down months, but it is one of the lower, dividend paying stocks that is essentially, or an ETF, that has the lowest volatility with a very, very good yield. The yield obviously fluctuates a little bit every single year, but ultimately 5% is pretty decent. And as I say, the dividend fund here, the volatility isn't too bad at all versus some other ones that you will find along the market. And the final one, and the more obvious one for most people, is the final 10% will go into the NASDAQ, pretty much the technology side of it, because you always want to have some sort of emerging market here. Now, again, we can talk about how performance has been amazing. It has over the course of time. Yes, there could be little bits of crashes here and there, but you are looking at the most obvious technology out here. This is why it's only 10%. Even over 10%, as you can see, it gives you, Nvidia, Apple, Microsoft, Broadcom, the lot. It gives you the whole exposure. But the thing is, technology over the last few decades will probably still continue to do well over the course of time without going all in. But you always have a little bit of exposure in the all world fund. You will have exposure to certain types of technology within any fund. But reality is, this is focused on it. This is why it's only 10%. So there could be some issues here. But you can see the volatility is much higher. You can earn a lot more money here, obviously. This is why it's only 10%. Don't go all in. But at the end of the day, the dividend yield, very, very small. But at the end of the day, that doesn't matter. But as I say, when we talk about volatility, it is much higher. So that is why it is split up into 3. So yeah, you are wondering now, 3 funds. Why is this a powerful setup? Well, it's kind of obvious in one sense and not in the other. You do have a broad diversification across the entire market because they are all good stocks with that all-world fund. Global diversification. With the dividend side, you have more stability and income, but you are getting the top UK ones, which kind of makes sense if you're in the UK, like myself, and in a stocks and shares ISA. You will get all of your monies without the withholding tax. And obviously, yes, the NASDAQ, the EQQQ, technology growth. If you're using technology, you should be betting on technology, realistically. Yes, there could be cyclical periods, but that is why it's only 10%. So yeah, you've got 3,500 plus stocks at least. You've got the UK dividend market, which is great for income. You've got the entire NASDAQ, which is amazing. And you've got the growth, the income, and the stability across all three, technically with different risk elements. Not to mention multiple countries, sectors, styles, and they are managed for you, which makes it even easier. We're going to do a simulation. We're going to use Snowball Analytics. There's a link below to this because there is a massive, massive discount. We're going to go through it in more detail in terms of the portfolio that I picked, the split ratio, the goals, and what it can grow into. But I would highly recommend try it out for free at least. You don't need a credit card or a debit card or whatever. 14 days free trial. And you can even look at, or even on the free plan, it's amazing. So get signed up. But yeah, 30% off until the 4th of December is an absolute monster deal. And I use this every day. I like to look at it for what my dividends are coming in, any news, information that may have missed me. You get a email every single week in terms of your overall performance, because I think the biggest problem that most people have as an investor, they don't plan their investments. They just go for it and go, oh, well, cool. Oh, I've got paid dividends, eh? Oh, lovely. Get to know everything. When you're going to get paid, what you're going to get paid, your overall growth in terms of the time horizon. It will decide pretty easily what stocks are good, what investments are good, what ETFs are good by just planning it. So this is a simulation. It is in real time technically with the prices, but what I have done, I've added some monies. The idea is the exact same funds here with £300 per month. We're going to run a projection. We're going to run it over the course of time. And you can easily do this on Trading 2 and 2 on any other platform. If you've got a goal in mind, go for it. Now, as you can see here, we've added the holdings in. Very, very simple. Let's have a little look at the overall plan. So obviously on Snowball, you're going to get the information pretty damn quickly in terms of overall gains, the passive income side. So already with this fund, 2.3% passive income already. And over the course of time, that yield on cost will grow. You can see the overall dividend growth, everything that you need to see in one hit. Diversification, as I've already alluded to it, we're going to go with a 30% split with terms of the dividends at the start point. The All World Fund 60 and obviously 10% roughly, give or take. Obviously, my numbers aren't amazing here, but at the end of the day, it keeps it super straightforward. So you're not over risking. Many people, in my opinion, fly into the All World funds with like minimal and go, oh, I don't care about that. And they go into the NASDAQ because they see the gains. You want to do it the other way around. The most amount of money should go into the All World Fund, and then obviously got some income, and then the higher risk stuff. And then eventually, say for example, if the NASDAQ starts to creep up a bit and goes to 20% by automatic, rebalance it a little bit. But let's talk about the other stuff. Obviously, the dividends, the yield on cost of this will increase over time, especially with if the dividend stocks start growing within that fund. But it depends on how much they rebalance. But as you can see, over the course of time, it is quite simplistic. But what we want to know, we want to do a little bit of a simulation in terms of what this could yield over the course of time. So obviously, yes, let's just put in 600,000. Now, the reason why I'm putting 600,000 is I want to see how many years this will take. With £300 per month, 3,600 a year into these, automatically, it kind of makes sense to just go for it and just see what happens. And already you can see within 31 years, this portfolio will be roughly with 10% average returns over the course of it, which I know is a bit iffy. It could happen, it might not happen, who knows. It's still a decent chunk from just a very, very simple habit. Now, as I say, you can rebalance this in 30 years' time. You'll be a lot older. You may want to put it in the income side of it. You may want to totally change those risk management parameters. But overall, you can see it's doing well. But as you can see, over a course of a couple of years, you're going to get a decent portfolio very, very quickly. And that's the scary thing, but that is only with that situation. Obviously, yes, reinvest in dividends. You may find more money underneath your account. You may buy houses. You may not want to invest as much. It just depends on where you are in your circumstances. But what this gives you is a bloody strong foundation. Now, obviously, yes, you can argue that the passive income side is going to be very, very different. And yes, it can be. But even in today's market with 2.3% yield, which could probably increase, with a decent growth, with those reinvestments and contributions, you are still looking to make at least £10,000 per year from magically autopiloting in 23 years. That is on top of your original investment. So what you'll basically see within 10 years, it'll start to compound because you're going to be investing even more on top of what you're already doing by just letting it just accumulate and just reinvesting those dividends. So over the course of time, it gets pretty good considering it's very, very beginner friendly. Everyone looks at, I want to make money very quickly overnight. It doesn't quite work like that. But this one, you can get wealthy by just being in the slow lane. And one thing with this fund kind of layout is you get paid quite a lot considering you're in 3 funds. So that's pretty good. And I know, obviously more money will build more money and that'll be good. But over the course of time, as you can see here, it could get very, very interesting. Now, just for fun, what I've done is I've added some more numbers onto it just to kind of showcase some realism here. But as you can see, there's a lot more money in here now, obviously. Obviously, ignore the total profit. It's done today. But the thing is, you can see the annual amount is still pretty good. The diversification has changed a little bit, but nothing crazy. But this could actually be realistic in terms of the NASDAQ may well start to creep up beyond this 10%, and this may go lower. But over course of time, as I say, as you get older, you will want to put more money into that. Therefore, then you're going to get more and more dividends. And as you can see here, the dividend payouts are pretty nice. The NASDAQ, you're going to get very, very minimal. But the other two, you're going to get enough. Obviously, the dividend one, you'll get a lot. But it just depends on where you want to go in terms of longevity. But over the course of time, it's going to get pretty meaty, especially when you're looking at the monthly payment of £600, roughly give or take, obviously, in certain ones. But yeah, there's some decent ones. There's some decent payouts there. Because what could happen is eventually, over the course of time, you will have most of your weight eventually into a dividend one for the income. And as you can see here, this is what it could look like longer tracks down the road, obviously. Now, this is the reality with it. Yes, your market portfolio will still swing pretty violently, considering the amount of gain here. I've only just put this in about an hour ago. It's already gone pretty mental. But that's the thing. The dividend side of it, you're going to get a decent yield. Over the course of time, this will obviously increase. That's something you can't really formulate. But the reality is you could still, if you've got a decent portfolio, totally flip it on its head and go, right, in 30 odd years, I could basically give myself an actual income. I don't have to reinvest that. I could literally pay myself, which is absolutely boggling, as you can see over the course of time. And some of the months are crazy. And if that is all tax-free, that is an absolute monster of a portfolio. So yeah, it's all about building a capital, then rebalancing it into that dividend side of it over time. And there you go. Winner, winner, chicken dinner. It's a winning plan, realistically. You just got to give it time. And that's it. The 3 funds that you realistically need as a beginner. You cannot go wrong with a simple, diversified, long-term approach that is very, very easy to automate every single month. And if you do enjoy these sort of videos, please do leave a like and comment what you think. And don't forget, watch this video. That's my portfolio currently.